Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We have an excellent show for you this morning. And as always, if you have any financial questions about your retirement, your portfolio, send them to Brian Rezny at ReznyWealth.com. We want to try and get as many questions today answered as possible. And again, those questions, send them to Brian Rezny at ReznyWealth.com. And do visit our website, ReznyWealth.com. Click on that special reports tab. The number one download report. If you want to protect your wealth, you want to secure your retirement, you want to avoid conflicts that are going to work against your hard-earned money, we've got a special report. The 3 biggest risks you must avoid now. It's a must-read for any retiree or pre-retiree if you're at all concerned about your portfolio and your financial security. We're in some turbulent times. I've added some great content to this report, and it really is going to give you an open up and give the light on the problems you, the investor, face and how you ultimately can protect your portfolio from bad advice and major market corrections and ultimately being sold bad investments by a so-called advisor. Go to ReznyWealth.com again, click on that special reports tab. You know, I've got a lot to talk about today with the stock market and bond market, and we're going to hit a lot of questions, of course, throughout this half hour. One of the things I do want to stress, October of last year kind of signaled a bottom, a great buying opportunity if you were a smart investor. The stock market right now is back around that 4,200 level, which is a major support level. We either need to break clearly above that, and our next target would be somewhere in the 4,800 range, or if we don't break through that significant, we actually could have a retest of those October lows. Either one is possible. So we're watching these things, of course, quite closely. Generally speaking, though, the economy looks like it's on level footing. The employment numbers look good. And one of the things you always want to look at is how is employment trending? While recently we've had some more increases in layoffs, it's not that drastic. So the economy, generally speaking, is growing a little bit slower, which is net positive, which we'll talk more about inflation again. Inflation is headed in the right direction. And really what you need to understand as an investor is when everything sounds terrible and bad, that often is some of the best times to invest in quality assets that you've actually researched that are of value prices. So inflation has peaked, well over a year ago, is on the significant downtrend. I'm more concerned at this point about deflation if the Fed actually raises rates more. I don't think they're going to. I think rates are up enough. I think the economy is slowing enough, and the supply chains are definitely coming back. In the fact that I think we're going to start seeing inflation continue lower, at least in the 3%, 2.5% range by the end of the year. It could actually be lower. The next couple months will be crucial. But I think you as the investor need to realize when it's time to make a change to a portfolio, you need to be timely on those changes. You can't get nervous. You can't sit idly by. You can't over-diversify your portfolio. You have to smart diversify in the right areas that are showing value, but also have a catalyst to drive higher. Whether that's the bond market, whether that's the stock market or real estate, all assets have opportunity at certain times of the business cycle. One of the main concerns I will say that is on the top of our list is really the commercial real estate market and smaller regional banks. Smaller regional banks, by the way, comprise the majority of banks in this country. Commercial real estate, in my opinion, there's going to be areas and pockets of trouble. We're not going to have a major collapse in commercial real estate overnight like we really saw back in the housing boom and bust in 2008. What I think we're going to see is over the next 2 to 4 years, a slow bleed off of commercial real estate, more small banks basically going under, not a catastrophic scenario on day one, but just kind of this slow grind. So if you own commercial real estate, you might have some issues. If you own regional bank investments, I would say there's a lot of ghosts in the closet, as we say, and could potentially torpedo your portfolio. So you really, at this point in time, need to be looking at your portfolio. Do you own commercial real estate or exposure to that through commercial bank stocks you may own? These are areas at this point I would clearly avoid. The other big thing is bonds and interest rates. Think about this. When interest rates go up, bond values go down. We've had a steep increase in interest rates over the last, let's say, 15, 18 months. Now, what I think we're going to start seeing well into the second half of this year is the Fed potentially reducing rates. So at this point, we are looking at more of intermediate term bonds, government treasuries, and or high quality corporates for capital appreciation. Remember, you don't just buy bonds for interest, you buy them for what's called total return. A bond can go up in value when rates go down, and you make the corresponding interest rate on that bond. Together, that creates total return. I think right now investors need to look at their bond positions, and if you have not made adjustments, this is a time, in my opinion, you want to lessen exposure to shorter term floating rate type securities and start to ease into more of an intermediate portfolio, again, depending on your risk profile. But I think the opportunities are going to be there overall in the overall stock market, and potentially some total return growth in the bond market. Let me go to my first question, Tom in Cape Coral. I own a substantial amount of Altria. I like the dividend, but the overall investment has been bad. Your thoughts? Sell? Question mark. Tom, I would not own Altria, and I would be a net seller of Altria. And I'll tell you why. It pays a hefty dividend, but dividend doesn't matter. It's the value of the asset. So if the stock goes up 2 or 3% a year and you had a nice dividend, that's a different story. If you have a stock that over a long period of time has been in the decline and you have a hefty dividend, your total return is actually pretty lousy. I think there's better places to put money if you have money in Altria that are better opportunities for growth, income, and total return. I think a lot of investors get hung up on the old, wow, it's paying this big dividend, and so they chase dividend. But you have to look at the asset price. Again, if you're making a 20% dividend and your assets dropping 20% a year, your total return is basically flat. And there are investments out there that are paying crazy, 8, 10, 12% dividends, but the value of the shares keep going down. You have to put that in count. Robert in Naples, Florida. I'm buying high-income closed-end mutual funds for income. What should I be worried about? Seems like a stable asset bucket. Stable asset bucket is not a way that I would explain closed-end funds. Closed-end funds typically deploy leverage, which we're against, and often a lot of leverage, 30, 40, 50% of the portfolio. Closed-end funds also usually pay out principal. So you're not getting income, Robert, you're getting what's called a distribution. Distribution is different than a dividend or income. So you might buy a closed-end fund or a bunch of them, which it sounds like you did, and let's just say they're paying 8% distribution. 4% could be from income, 4% could be from your own money. That's why if you look at most closed-end funds, their charts always go on the downside, point down. So your total return on closed-end funds is actually quite lousy on the vast majority. They have more risk than other assets that I think could perform better. And so you, the investor, need to understand, kind of like the Altria question, why is it paying this high distribution rate? Which again is not income and dividend. You, the investor, have to make sure, again, you understand the difference between a dividend, a distribution, and total return. I'm going to take a quick break. When I come back, we're going to take some more questions. Make sure you go to ReznyWealth.com, click on the consultation tab if you'd like to talk to my firm about professionally managing your portfolio. If you have concerns about the current advice you're receiving or lackluster returns, bad client communication and service, it's time you talk to my firm, and let's get you back on track. You can also download any of our groundbreaking reports. Again, go to ReznyWealth.com, click on the special reports tab, and make sure you definitely download the 3 biggest risks you must avoid now. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, the 3 biggest risks you must avoid now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. And we're back, and I hope you're enjoying today's program. As always, send your questions to Brian Rezny at ReznyWealth.com. And make sure, again, you visit our website, ReznyWealth.com, and download any of our groundbreaking reports. They're instant download, instant read, and they're free. Again, special reports tab, our number one download report currently, the 3 biggest risks you must avoid now. You need to read it, you need to read it twice, and you need to study to make sure you understand how to avoid the pitfalls that really plague retirees and pre-retirees, how to avoid the conflicts of banks, insurance companies, Wall Street style firms, these things that come against your returns, and ultimately conflicts that really can take away from your financial security. Again, go to ReznyWealth.com. Victor in Naples, Florida. I bought Plantier on the IPO and lost 80%. Will this come back in your opinion? Victor, the company itself, I like the strategy. I think the company's a good company, but personally I think it's overvalued, even though it's dropped over 80% in value. This is a stock that came out as an IPO a couple years ago, raced up a lot, I don't know, 300-400%, only then to come crashing down after the COVID was basically over. So investors who did the IPO overpaid for the shares, and unfortunately too many people, again, get into these hyped up stocks that really might go a little somewhere, but certainly shouldn't be trading at 300 and 400 PE ratios, which that company was at one time. I don't really like the stock overall. I think there's other areas of opportunity. What you might want to consider doing is selling the stock, take your tax loss, do some research on the stock because maybe you didn't the first time, and if it makes sense to add it back in the portfolio, do it after 31 days so you don't get a tax sale wash. Take the tax loss, position yourself back in if, again, after real research, you deem this to be an opportunity for the next 1, 2, or 5 years. One of the things I always like to discuss, and I get a lot of questions on this, by the way, so I'm going to kind of lump some of these together today. The number one question that I receive on my TV and radio shows is about annuities. We receive so many calls, not only to our office, but on my TV radio shows, from disgruntled people that were sold annuities. I'm going to say this. If you go to a free steak dinner seminar, that's a salesman trying to sell you an annuity. There are no good annuities. There's just investors that didn't read the fine print, were basically sold an investment they think is going to do more than it's going to. And then once you get into these annuities, you have insane lockup periods and surrender periods to get all of your money out. As I've always tried to educate every investor, never ever buy any investment that has a back-end load, like annuities, or surrender fees, like annuities, that have crazy high cost structure, like annuities. There are not good annuities. There's just investors who didn't understand and were sold, or maybe potentially really lied to by that so-called advisor. Again, free steak dinner might be tasty, but if it's at the jeopardy of your retirement, and I've seen more damage done in carnage from these so-called advisors selling you, the unsuspecting investor, an annuity, only to realize after 3 or 4 years you were duped and your retirement's in jeopardy. Don't take that route. Don't be sold. Read the fine print. If you want to learn more about why annuities are dangerous to your retirement and your wealth, go to ReznyWealth.com. Click on the Special Reports tab. You can download our groundbreaking report, Why Annuities Are Dangerous to Your Wealth and Retirement. Protect your money from bad advice. And again, don't be sold bad investments. Bob in Naples, Florida. Do you think a dividend strategy is best for a conservative investor? Bob, what I would say in general is this. You want to look at dividends as part of an overall strategy, but don't just look at a dividend strategy. Let me explain. There's a lot of different people out there, let's say, that push a dividend strategy, meaning you buy high dividend paying stocks only. That's a mistake. About 80% of stocks in the overall marketplace don't pay any dividend or very little dividend. Okay, so if you only buy high dividend paying stocks, you're taking 80% of potentially good stocks that would potentially have a much better total return than just this minute little percentage you're picking from on a dividend strategy. We like to look at total return. So dividend and growth potential, in our opinion, is far superior than just having a dividend strategy portfolio. I think people, again, it's kind of like Altria or these closed-end mutual funds that we had questions on earlier. People get kind of locked into these so-called high dividend structure investments, really at the detriment of total return. So I'm not a big believer. Dividends are important, but it needs to be in a total return structure. Ryan in Cape Coral, Florida. What do you think about Alibaba? You know, I think the company, generally speaking, is a good company, but I would stay away from the stock. And again, the reason is China. China's got their hands in every company that's inside China. There's too many risks right now with China, and I don't think that's going to stop anytime soon. We own no assets currently in China, and we are not looking to buy any anytime soon. And again, the Chinese government has their thumb on the scale of these companies. They can dictate what goes on and what could or not happen, and this could be at the detriment of your money. Currently at Rezny Wealth Management, we are currently 100% in the U.S. marketplace. And the reason we're in the U.S. marketplace is it's showing us the best opportunity on a risk-reward standpoint. So you could be well diversified in the U.S., okay, and not have to go to China or the emerging markets or Europe. And I've talked about Europe quite a bit for years. A lot of you out there have investments in international funds, because if you're working with a Wall Street style firm or bank, they believe in what's called stock asset allocation. It's a set it and forget it portfolio. Regardless what they tell you, Wall Street believes in asset allocation, spreading your money all over the place. Even international investments are in your portfolio for 10 or 20 years that haven't done anything, and really probably will have very little opportunity to do anything in the future because, again, of their structure and the way their governments are run. So as an investor, put your money in the place it has the best opportunity and will be treated best. China certainly is not it, and Europe certainly is not the best place for your money. Currently, we feel at Rezny Wealth Management, the U.S. marketplace still is the predominant leader for a risk-reward ratio that ultimately can help benefit your portfolio on the upside. Go to ReznyWealth.com. That's ReznyWealth.com. By the way, you can sign up for instant email alerts via our website. You can download any of our groundbreaking reports. Our current report, The 3 Biggest Risks You Must Avoid Now, is available for a free download. Again, go to ReznyWealth.com, click on the Special Reports tab. You know, we really try to educate you, the investor, and we want to make sure that you make good decisions. One of the things I've said for years is learn from others' mistakes. It's less costly to you. So if you want to learn from others' mistakes, go to ReznyWealth.com, download any of our groundbreaking reports, learn, educate yourself. It's good for your retirement. It's good for your financial security, and ultimately it's going to help you move ahead in the direction you'd like to go, which is up versus on a negative downtrend. I'm going to take a quick break. When I come back, I'll take more questions. So if you have a question about your portfolio, financial question, retirement, send them to Brian Rezny at ReznyWealth.com. I'll be right back after this. Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report radio and TV show. I've just released a groundbreaking report, The 3 Biggest Risks You Must Avoid Now. I've covered the major risks that create financial ruins for many retirees. If you're at all questioning the advice you're receiving, this is a must-read report. Go to ReznyWealth.com for your free copy. Educate yourself, protect your retirement and portfolio. And we're back, and I hope you're enjoying today's program. As always, send your questions to Brian Rezny at ReznyWealth.com. Here in Cape Coral, Florida, I worked for Ford for 40 years. Now retired, I still own a lot of stock. What's your thoughts? I think Ford's a good company. I think it's a bad investment. And if you own a lot of the stock, first off, cardinal rule number 1, never own more than 5% of any one individual stock. Doesn't matter if you work there, if you own the company, if you think you know it better than everybody else, owning more than 5% puts you at substantial risk of portfolio loss. Ford stock has done pretty darn lousy for decades. It had a dividend, cut the dividend, all these different things have happened to Ford over time. What I would say is this: if you own Ford, I would be a seller of Ford. Maybe you sell your position down to 5% of your portfolio and hang on to 5% if you really think it's going to do something. I don't think Ford's a great opportunity. I think there's too many other investments out there that are much better opportunities than Ford is and Ford will ever be. So again, Ford, in my opinion, is one of those things you should avoid, you should sell. Car companies and airlines are probably the two worst sectors you can invest in. High capital cost and, of course, low margin. And couple that with any time there's either a geopolitical event or recession, airline stocks, auto stocks, kaboom, they crash in a bad way. Don't own them. There's better places in the marketplace you can invest your money. Tim in Naples, Florida. I was sold 2 equity index annuities and 1 variable annuity 5 years ago. None have done well. I heard your show last week and you hate annuities. How can I get out? First off, Tim, I'd say go to my website, ReznyWealth.com, special reports tab on the top, click it. Why annuities are dangerous to your wealth and retirement. You should download that report and read it. It's a must read for anybody who got themselves into an annuity or is thinking of being sold an annuity. And I use the word sold strongly. Read that report. So how can you get out of these annuities? Now, first off, you bought these not too long ago, so that means you probably have big surrender penalties if you cash them out. So you've got 3 different choices. Choice number 1, take out your 10% penalty free each year and take that money and hire a real firm to manage it properly. That's number 1. A better option, in my opinion, is take out your 10% a year and another 10%, pay the penalty on that, and bleed the annuity dry over, let's say, the next 3 or 4 years. Move that other money into a professionally managed account and get real advice and real money management. Your third option is say, hey, you know what, Tim? You made a big mistake. Brush it off. Cash in the annuity. You can take the surrender hit. Move on to greener pastures. Those are really your 3 best options. I know which one that I would take if I was presented it, but that's only a decision you can ultimately make. I think so many investors are sold these annuities, and again, it takes them 3-4 years to realize they were duped. I have yet, in 30 years managing money, had somebody say to me, boy, I'm glad I bought that annuity from that broker or the guy at the free steak dinner. We just don't hear it. We hear nothing but horror stories, and we see horror stories. So again, avoid bad advice. One of the things that I think, especially today, is knowing when to sell, and knowing when to sell is vastly more important than when to buy. Let me explain. You're thinking about buying a stock. You buy XYZ stock. And I will say most people don't do the proper research before they buy a stock. But before you buy the stock, you need to know the reasons you're going to sell that stock. Think about it. If you buy a stock without a lot of research and without a real strategy, let's say you buy Apple just because it's Apple Computer, and that's how people, generally speaking, buy stocks. It's Apple, it's great, and that's what they think. So they buy it. So now you own it. So Apple starts going down and down and down and down and down, and you're like, oh, I don't know what to do. Because you don't have a sell strategy. You need to deploy a sell strategy. A sell strategy basically is opposite of a buy strategy. If you properly research the stock and there's reasons you're buying that stock for fundamental reasons, technical reasons, when the reverse happens on that stock, that would trigger a sell discipline. And by having a sell strategy or discipline, what you're doing is you can help alleviate major catastrophic events, kind of like the one question we had on Plantier, where the person bought it on the IPO, it dropped 80%. He should have a sell strategy that basically told him to get rid of this thing after it was down 10 or 20%, not 80. But he probably didn't have a sell strategy because he probably never really researched the stock. He just bought it on the IPO and he thought it was going to be a great investment. Mark in Boca Raton, Florida. What is your market outlook for the next 6 months, 3 years? There seems to be a lot of recession calls. Love your show. Thanks for the nice comments, Mark. I will say this. When we look at recession, I look at what all the Wall Street firms have said the last year and a half. Think about this, folks. If you listen to any financial broadcast, the big financial Wall Street style firms, the ones that are always getting fined and censured for misdoings against you, the client, the big banks that are being fined and censured all the time, the insurance companies, the majority, vast majority, world's coming to an end, major recession coming. Look at this year, 2023. The market's off to a great start if you're properly positioned. Great start for the first half of the year. But what were the major Wall Street firms saying? Recession, recession, recession. So you just missed out. My guess is if you're with one of these big firms, last year wasn't that great of a year for you either. So last year wasn't a great year. This year's not a great year. And basically, who's the big loser? Your financial security, your portfolio, your retirement. So I'm going to say this. Generally speaking, I think things are going to be rosy. Not super rosy, but there's going to be pockets of volatility. I think there's great opportunity the second half of this year. We were positioned at Rezny Wealth Management for a decent economy and a decent equity market this year, and we feel that's paid off for our clients. So again, we don't follow Wall Street because they're always wrong, they're deceptive, and they're full of conflicts of interest. You, the investor, need to understand, if you listen to the mainstream media, the information you're going to get is pretty much worthless. Find yourself a real fee-only fiduciary money management firm like a Rezny Wealth Management. Continue to watch our shows. We give you real advice on our shows that is not conflicted like a Wall Street firm or a bank. Watch out for what the media tells you, because again, they're often and almost all the time wrong on every account. Doug in Alaska, my advisor, went to cash a number of times. We lost a lot of market recovery. I now question his ability. So one of the things that happens, Doug, with not only individuals, but this happens with advisors. Remember, a lot of advisors are not money managers. They're really advisors working at a big firm that are selling the products that they are required to sell. Whether it's the money management services, whether it's the mutual funds, ETFs, stocks, bonds, they're really a salesperson and also a customer service rep to you, not really a money manager. So what it sounds like is your advisor, we've had a lot of clients hire us over the years with the same comment. Their advisor gets all emotional and starts putting their clients in cash at exactly the wrong time. So what ultimately happens to your portfolio? That the advisor was wrong on the timing when to sell, market recovers, then he puts you back and the market drops again. So you have to be right twice. So market timing does not work. Can you change portfolio allocations and things of that nature to slow down some of that volatility? Sure. But just getting in and out of the market constantly is really a bad situation. We are just about out of time, folks. Make sure you go to ReznyWealth.com. If you're tired of bad advice, you want to talk to a real money management firm, go to ReznyWealth.com, click on that consultation tab, or give us a call during the week. We'd love to help you and your portfolio. Have a safe and profitable day.